All right, let's kick things off with a pretty wild scenario. What happens to your trading business if you literally lose exactly 100 trades in a row? For most people, the answer is a blown account, a completely ruined mindset, and honestly, a whole lot of emotional pain. Most traders are just gambling without even realizing it. But what if there was a mathematical framework that actually required 100 consecutive losses just to liquidate you? Welcome to This Explainer, where we're going to break down the foundational mathematics of professional trading and capital preservation. Without this exact framework from our source material, everyday market volatility will eventually deplete your account, no matter how accurate your strategy might be. You have to view your trading capital as your inventory. If a store runs out of inventory, it can't make sales. If you run out of capital, well, your business simply ceases to exist. So the core premise we're looking at today is known as the 1% rule. This rule dictates that you never, under any circumstances, risk more than 1% of your total account equity on a single trade. If you're working with a $10,000 account, your absolute maximum loss for any single position is just $100. Adopting this creates a massive psychological shift in your brain. You immediately switch from asking, how much money can I make today, to how much am I actually allowed to lose? That shift in mindset is absolutely everything, right? Because this strict boundary creates a massive, almost impenetrable protective buffer around your money. By strictly sticking to this limit, you force a situation where it would take 100 consecutive losses to completely drain your capital. It turns account liquidation from this constant looming threat into an absolute statistical rarity. You remain operational, and most importantly, you stay in the game for the next opportunity. All right, moving on to a slightly uncomfortable question about your pre-trade routine. Do you actually know your exact position size before you enter a trade, or are you kind of just guessing how many shares to buy based on how confident you feel about the chart? Don't get me wrong, feeling confident is great, but it is definitely not a mathematical sizing strategy. To figure out the correct size and totally eliminate that guesswork, you have to strictly identify 3 key data points before you ever click the buy button. First, your current account equity. Second, your chosen risk percentage, which is our 1% maximum. And third, your exact stop-loss distance. You literally cannot determine how many shares or contracts to buy until you know exactly where you're going to exit if the market moves against you. Let's actually run the formula from our source material so you can see this math in action. It's your account balance times your risk percentage divided by the stop-loss distance. So for example, if you're trading a stock with a $20,000 account, your 1% risk is $200. If your strategy requires a $2 stop loss based on the technical structure, you divide $200 by $2. That gives you exactly 100 shares. And this brilliantly highlights the main takeaway for this segment. A tighter stop loss allows a larger position size, while a wider, looser stop loss requires a much smaller position size. Your trade size has to constantly fluctuate based on the specific volatility of the setup, but your actual risk dollars never change. They are always capped at that 1%. Master this, and you completely control the chaos of the markets. Of course, to accurately measure those exact stop-loss distances in real time, you really need the right tools. Save $15 using our referral link in the description to get the standard in charting with TradingView. It is the absolute fastest way to follow the markets and calculate your risk precisely. Okay, let's tackle a huge roadblock that trips up almost everyone at some point. Do you let a massive position price tag totally scare you out of a valid trade? Or, on the flip side, do you blindly over-leverage your account just because a particular stock or coin seems cheap? To get past this, you have to completely separate notional value from risk capital in your head. Notional value is the total face value of the assets you control. If you buy 100 shares of a $150 stock, the notional value is a massive $15,000. But if your stop loss is set just $5 below your entry at $145, your actual risk capital is only $500. New traders constantly confuse these two numbers, which leads them to either trade way too small out of fear or take on catastrophic levels of risk. Now, as you adapt this across different asset classes, the math obviously changes. For equities, it's straightforward dollars. For Forex, you base it on pip value. But look at futures. You have to account for the tick or point value. For instance, on a micro E-mini S&P 500 contract, where each point is worth $5, a 10-point stop equals a $50 risk per contract. If your 1% limit is $150, you're allowed exactly 3 micro contracts, no more, no less. So the big actionable rule here? Your mental focus has to stay entirely on the risk capital. The 1% rule does not care about that $15,000 notional face value. It only cares about the exact dollar amount you will lose if that stop triggers. You have to trade the risk, not the face value. Statistically speaking, even the best, highly accurate strategists are going to face 10 or more consecutive losses eventually. It's just a harsh mathematical reality when you're dealing with probability and edge. Which brings us to a terrifying question. What actually happens to your hard-earned account when that inevitable losing streak finally hits? Just take a look at the massive difference in this drawdown data. By risking only 1% per trade, a devastating 10-trade losing streak results in a total drawdown of roughly 9.5%. It hurts, sure, but you survive. However, if you were risking 10% per trade, that exact same 10-trade streak causes a devastating 65% loss. A 65% loss requires nearly a 200% gain just to get back to break even. The 1% rule keeps the financial impact completely manageable. But hey, what if you're actively managing multiple open trades at once? The 1% rule applies to individual trades, but you also have to aggressively manage your correlated risk. If you enter 5 different tech stocks at 1% risk each, your account is effectively sitting at a 5% risk to a single sector-wide event, like an unexpected earnings miss or an interest rate hike. To survive a true black swan event, you must deliberately cap your total market exposure to a strict 5% or 6% ceiling. This entire setup is called fixed fractional position sizing, and the ultimate takeaway here is its brilliant dynamic nature. As your account balance drops during a painful drawdown, your 1% risk automatically decreases in dollar terms. This perfectly protects you by slowing down the rate of decay. On the flip side, as you win and your account grows, your 1% automatically allows you to trade larger sizes, mathematically compounding your winning streaks. All right, here is a critical question about your daily execution. Are you placing arbitrary dollar amount stops just to force a larger position size into your account? Or are you logically placing them based on what the chart is actually doing? Your stop losses absolutely have to be placed at real technical invalidation points, like below a recent swing low or cleanly outside a price channel. If you decide you only want to risk $100 and you place your stop too close to the current price just to make the math work for a large position, you drastically increase the probability of getting stopped out by normal, everyday market noise right before the price violently reverses back in your intended direction. That is the most frustrating feeling in trading, and it's 100% avoidable. Professionalism is really defined by following a strict mechanical checklist every single time. First, identify a logical technical stop loss where the trade idea is genuinely proven wrong. Second, calculate the position size to fit your 1% risk constraint. Third, and this might be the most important part, have the immense discipline to skip the trade entirely if the technical stop is so wide that you cannot even trade a single unit within your 1% limit. The major takeaway here is that beyond just preserving your cash, this discipline gives you massive psychological stability over the long run. When you know deep down that no single trade can ruin you, it totally removes the fear, the anxiety, and that horrible analysis paralysis. By keeping risks small and consistent, you can calmly treat each trade as exactly what it is, just a single data point in a very large series of executions. So, are you ready to stop gambling and start protecting your capital like a pro? Ultimately, turning these dry mathematical concepts into your permanent trading foundation changes absolutely everything. Over time, this mechanical, rules-based approach removes the exhausting emotional burden of deciding how much to trade on the fly. It turns risk management into a cold, objective, and repeatable process. For additional solutions and to really master these exact mechanics in live, fast-moving markets, make sure to purchase a copy of the Funded Micro Modern Future Strategies for the Prop Firm Era at thefranksreport.com. To wrap up, here is your ultimate survival checklist directly summarized from the source material. Never risk more than 1% per trade. Always calculate your size based on technical stops, not arbitrary dollar amounts. Separate your massive notional value from your actual true risk capital. Cap your total correlated exposure across the entire market at a strict 5%. And finally, consistently use a sizing calculator for every single setup to ensure your trading business never, ever runs out of inventory. I'll leave you with this final, crucial thought to challenge how you approach the markets tomorrow morning. When that opening bell rings and the chart starts rapidly moving, will your next execution be a hopeful, emotional gamble, or will it be a heavily defended, mathematically calculated risk? The choice is totally yours,
but only one approach guarantees you'll live to trade another day.